Hello, my name is Tony Flint, attorney at Zywave. Today I will be presenting workers' compensation insurance and independent contractors. I am a content attorney at Zywave and I specialize in employment and other workplace laws. Zywave provides software-based solutions to insurance brokers to help them support risk managers, HR professionals, and C-suite executives looking to navigate today's complex legal and regulatory environment. Specifically, I focus on creating user-friendly resources to help organizations minimize their exposures and protect their business. When you hire a worker, one of the first determinations you need to make, possibly even before you schedule an interview, is whether you are hiring an employee or an independent contractor. This determination is known as employee classification. For today's presentation, I will begin by describing the advantages and disadvantages of hiring independent contractors and how employee misclassification can affect your workers' compensation policy. We will then dive into the two tests used to determine employee classification status on the federal level. From there, I will describe how misclassifying employees can adversely affect your business financially, and I will outline steps you can take to protect your business from employee misclassification. Hiring independent contractors has several benefits. For example, employers may wish to hire workers with specialized expertise to complete projects on a temporary basis or for a set limited period of time. Another primary reason that classifying a worker as an independent contractor is an attractive option for an employer is that many of the legal and administrative requirements that apply to employees do not apply to independent contractors. In addition, employers are generally not required to pay for the medical bills for work-related injuries suffered by independent contractors. Despite these benefits, many employers are hesitant to hire independent contractors due to the risks of employee misclassification. From a workers' compensation perspective, if an employer improperly classifies a worker as an independent contractor rather than an employee, the employer may be liable to pay for the injured worker's medical expenses. In addition to workers' compensation, several other employee misclassification issues exist for employers. First, the Internal Revenue Service has several tax and withholding requirements for wages of employees. The IRS does not impose these requirements on workers that qualify as independent contractors. Second, only bona fide employees receive protection of federal employment laws. Employers that misclassify employees as independent contractors can be subject to stiff penalties from the IRS and other state and federal agencies for misclassification. Misclassification is a risk all employers should be aware of. One federal study concluded that approximately 3.4 million workers are misclassified as independent contractors annually, and as many as 30% of companies misclassify employees each year. At the federal level, there are several tests used to determine whether a worker qualifies as an employee or an independent contractor. We will review two tests today, the IRS 20-factor test and the economic realities test. It is important for employers to note that the IRS 20-factor test and the economic realities test apply in different situations. Employee classification under workers' compensation law varies from state to state. However, these federal tests can serve as a baseline to help develop sound employee classification practices. First, we will review the IRS 20-factor test. In general, whether someone is an employee or an independent contractor depends on how much control the individual has over the work that is being done. The 20-factor test is primarily used to determine an employer's tax and withholding requirements for worker wages. We will not review all the factors of the IRS's 20-factor test. However, the IRS test can be divided into three general categories: behavior control, financial control, and the type of relationship. Behavioral control is evaluated by how much an employer directs and controls work. Relevant factors include who determines when and where the work is done, what tools or equipment are used, and whether or not the worker receives training. Financial control is evaluated by factors like whether the worker is reimbursed for business expenses, whether the worker invested in the business, and whether the worker provides services to more than one employer. Finally, the type of relationship is established by factors like whether the worker and business have a contract that describes their employment relationship, whether the employment relationship is permanent or indefinite, and whether the business provides employment-like benefits to the worker. Again, the more control the employer exercises over a worker's daily activities, the more likely the worker qualifies as an employee rather than an independent contractor. For more information on the IRS's 20-factor test, visit the IRS's website at www.irs.gov. The second employee classification test we will use today is the economic realities test. Unlike the IRS test, which is used to determine tax liability, the economic realities test is predominantly used when evaluating whether an individual's rights were violated in the employment law context. If a worker meets all of the factors of the test, then they are covered under federal employment laws like the Fair Labor Standards Act and the Family Medical Leave Act. The economic realities test has 6 factors. First, a worker can only have a limited amount of investment in the employer's equipment and facilities in order to qualify as an employee. Second, a worker's compensation cannot be tied too heavily to business profits. A worker may only have limited opportunities for profit and loss related to the employer's operations in order to qualify as an employee. Third, a worker qualifies as an employee if the employer closely supervises the worker and the employer has a high degree of control over the worker in the workplace. Fourth, in order to qualify as an employee, a worker can only have a small amount of judgment or initiative in the overall success of the operation. Next, the employment relationship between the worker and the employer should be permanent. For example, seasonal workers do not meet this permanency requirement and may not be eligible for certain legal protections granted to employees. Finally, the worker's job responsibilities must contribute to or be an integral or essential part of a company's business. If an employer chooses to use independent contractors, there are several steps they can take to minimize their risk of misclassification. An independent contractor agreement can help an employer clearly establish an independent contractor relationship with a worker. The agreement can include a description of the limited nature of services performed, the length of the employment period, and the means of payment to the worker. However, a contract itself will not provide complete protection to an employer. Employers should also audit their current worker relationships to ensure that all workers are properly classified. Through proper use of independent contractor agreements and properly auditing current employment relationships with workers, employers will minimize their risks of worker misclassification. Your broker has resources to help classify workers and keep your organization protected from costly litigation. As new issues arise, your broker will help your understanding of what's happening and what can be done to protect your business. Being proactive in addressing the various risks your team faces will help protect your business in the long term. Thank you for your time today.